Hello everyone, Alex is here. I hope you're doing well. I hope you're staying safe and you clicked on this video to watch something interesting. Today we're going to be looking at US dividend ETFs. So these ones are actually very important and they're very good for a couple of reasons. The US stock market generally have ETFs with the lowest fees. US stock market also have the most number of stocks, the most number of dividend paying stocks, and the most number of dividend stocks that increase their dividends. And also US stock market historically perform better than Canadian stock market. And also you can hold all of this on your RSP account to avoid paying any dividend taxes. And for today's video, I looked at all the dividend paying ETFs on the US stock market and I collected 4 best ones out there based on some of the metrics. The lowest fee, the pretty good dividend yield, the portfolio diversification, and also long-term returns. And to remind you that the fee that is attached to ETFs, which is MER, Management Expense Ratio, is actually not something that you need to pay. It's not going to appear as a transaction on your account. It's actually added to the price of the ETF itself. And a nice way to look at it is actually subtract your MER from the yield. So say if the yield of your ETF is 4%, and the MER for this ETF is actually at 0.2%, for example, then your effective net income is going to be 3.8%. And that is just dividend. It does not include share price appreciation over time. And if you compare that to a mutual fund with a 2% expense ratio, you can take a look at one of my videos where I go about comparing ETFs and mutual funds, how they differ, and how to choose what works for you. And before we start looking at this dividend ETFs on the US stock market, one important thing you need to know, my Canadian friends, is that you would need to pay withholding tax of 15% for all the US dividends you'll be getting. But if you hold your US securities on your RSP account, ETFs or US stocks and all that, then that account is actually tax exempt from this withholding tax. So you're not going to be paying that. So the best account for these ETFs or for US dividend stocks or for any other US securities is your RSP account. The next best account is going to be your personal account, your margin account, or like regular account, right? Where you would be required to pay this 15% withholding tax for all the dividends, but you actually can return it via foreign tax credit. And if you decide to hold this on your TFSA account, then you would actually be required to pay this 15% withholding tax, and there is no way to recover from that. So use your RSP or your margin account. Let's go. And the first one for today is going to be SCHG, which is Schwab US Dividend Equity ETF. And this fund actually tracks the Dow Jones US Dividend 100 Index, which includes some of the highest dividend producing stocks in the US. It's actually one of the lowest fee dividend ETFs with a MER of 0.06%, which is only $6 for your $10,000 investments, or 60 cents for your $1,000 investments, which is basically nothing. It is one of the lowest fees you can get for dividend ETF. The objective they have is actually to focus on the quality companies with very sustainable dividends. And with this, their approach gives them the companies mostly from the larger cap, and also they exclude all the real estate investment trusts. They review the composition of their portfolio on the annual basis, and they also rebalance their portfolio every single quarter. Let's take a look what the sectors are covered with this ETF. They have around 20% for information technology, around 20% for financials, around 15% for consumer staples, 14% for industrials, healthcare is 12%, consumer discretionary is 7%, communication services 4%, materials is 3%, and energy is only 1.7%. And their top 10 holdings include companies such as Home Depot, IBM, Pfizer, Pepsi, Coca-Cola, 3M, and more. Let's see what we have from our metrics for SCHG. So the assets under management they have is around $25 billion. In total, they have 103 stocks in their portfolio. Their MER, as I said, is at 0.06%, and their current dividend yield is at 2.8%. And their effective dividend yield, if you subtract the MER, is going to be 2.74%, which is pretty good for the dividend ETF like that. Looking at compound return for SCHG since the inception of this ETF, which was 2011 actually, so it was right after the market crash of 2008, and the compound return is at 15%, which compares very nicely to S&P 500 index, which was at 10.4% for the same time period. Their driven amount is actually on the higher end, is around $12,000, so you would require to invest $12,000 for this ETF if you would like to reinvest automatically back to this ETF. But as you might know, DRIP is optional. You don't have to do it at all. You can just invest in this company, into this ETF set of companies, and get your dividends paid out to you every single quarter. Let's move on to the next one, which is VYM, Vanguard High Dividend Yield ETF. This ETF from Vanguard actually tracks the FTSE High Dividend Yield Index. The fund represents almost 400 stocks that produce high dividend yields. And the good thing about this one as well is that the fee is also on the lower side, is at 0.06%. So far for the two ETFs we just talked about, we're staying at a very low territory in terms of the expense ratio. Let's see the sector allocation for this ETF. They have around 22% financials, around 13% in consumer staples, 12% for healthcare, that's a good chunk, around 10% for industrials, and around 8.5% for consumer discretionary, around 7% for technology, so this one is very low on technology, around 7% for telecommunications, utilities is 8%, and energy for 6%, with basic materials at the lower end for 4.8%. And in terms of the largest holdings this ETF has, they include companies like JP Morgan, Johnson & Johnson, Home Depot as well, Procter & Gamble, Bank of America, Comcast, ExxonMobil, Verizon, Intel, and AT&T. And these are the companies that everybody knows. You can actually invest directly into these stocks. I actually talked about one of the best monthly dividend paying US stocks in one of my recent videos. You can check it out here. So no one is stopping you to invest directly into US stocks, but you would need to diversify your portfolio yourself and understand that the sectors you have in your portfolio are actually covered enough. Let's take a look what we have from our metrics for this ETF. They have around 46.5 billion in assets under management, and their portfolio is a lot larger than the previous ETF. This one has around 416 stocks in their portfolio. And their MER, though, as we just talked about, is on the low end, which is pretty good. It's at 0.06%. And their current dividend yield is at 2.9%, which gives us an effective dividend yield is at 2.84%, which is pretty generous and actually pretty consistent with the previous ETF. But you can see that allocation between the different sectors is slightly different. So these two ETFs actually add to each other. And VYM is also paying their dividends on a quarterly basis. Looking at the compound returns for this ETF since the inception, which was 2006, is actually at 8.4%, which is lower than the previous ETF, but also this ETF actually existed for 5 more years. And this one went through the market crash of 2008, so keep that in mind. The DRIP one for VYM is also on the higher end, and it's at $17,800. That's a lot of money. So if you want to set up DRIP for this ETF, there's going to be the amount you would need to invest. All right, let's move on to the next one. We have a couple more to go. And the next one is SPYD, which is the Spider Portfolio S&P 500 High Dividend ETF. And this ETF is trying to do the best of its abilities to track the S&P 500 High Dividend Index. And the MER for this ETF is also on the lower end. That's pretty nice, huh? So they have it at 0.07%, which is pretty good to see. And because this is a passively managed ETF, they just track the index. That's why the MER is also on the lower end. And the other good thing about this ETF, which is better than the others ETF, is that their yield. The current dividend yield is at 4.6%, which means that you'll be getting more dividends every single quarter. But this not necessarily means that your overall returns on the long term is going to be better, because the appreciation of this ETF might be lower than for other ETFs. Let's take a look what sectors are covered for this ETF. They have 24% for financials. They also have real estate in their portfolio, around 19%. They have energy covered a lot more than the others two at 14%. They have utilities also on the higher end, around 12%. Information technology is at 7%, so on the lower end here. Communication services at 6.3%. Consumer staples at 5%. Materials, consumer discretionary, and healthcare, it's at 5%, 3%, and 3% respectively. So now with this ETF, you have a pretty good diversification into real estate, and that's what's probably driving their higher dividend yield. In terms of the largest holdings they have in their portfolio, there will be companies such as Seagate Technology Holdings, Iron Mountain, Lincoln National Corporation, Fifth Third Bancorp, Regency Centers Corporation, and more. Now let's take a look at the metric for SPYD. The assets under management they have is around $4.5 billion. Their portfolio consists of 78 stocks, and their MAR is actually on the lower end, as we talked about, is at 0.07%. But their dividend yield is actually on the higher end, is at 4.6%, which gives us an effective dividend yield at 4.53%, which is pretty good. It's on the higher end if you compare to the first two we talked about, but it's not necessarily mean that over a long-term period, the return is going to be higher. It just means that with every single dividend payment, you'll be getting more dividends back if you compare to the first two. They also pay out dividends on a quarterly basis, the same as the first two ETF we talked about. And looking at the compound returns for this ETF since their inception, and they're actually a pretty new ETF on the market. They just appeared in 2015. So the return since then they have, the compound return since then they have, is at 9%. So as you can see, the overall return is actually lower if you compare it to SCHG over the longer period of time. The drip amount though that you need to invest in order to get this dividend reinvestment thing flowing is actually on the lower end here, is at $2,900. So it's a very easy and affordable drip for this ETF if you want to have this reinvestments flowing and gain from the compounding growth over time automatically. And the last one for today is actually a pretty good ETF. I have it on my portfolio in my RSP account as well, and I love it very much. They give you monthly dividend payments, and it's going to be SCHG, which is Invesco S&P 500 High Dividend Low Volatility ETF. And this ETF is actually based on the S&P 500 Low Volatility High Dividend Index. And this ETF is focused on just 50 stocks that offer above average payouts, but also lower share price volatility over the last 12 months. They rebalance and recomposite their portfolio twice a year. Let's take a look what are the sectors that are covered in this ETF. And this one is actually have the largest amount into utility stocks, around 18%. Then they have consumer staples at 15%, information technology at around 12%, communication services 11%, energy 8%. They also have real estate around 7.7%, materials 7%, healthcare around 7.5%, consumer discretionary at 5%, financials on the lower side around 5%, which is pretty good. If you looked at the other ETFs we just talked about, they have a pretty big exposure to financials, where this one is actually on the lower end. And they also have industrials at around 1.5%. And the top 10 holdings they have in their portfolio. And they will have companies such as Iron Mountain, Lumen Technologies, ExxonMobil, Kinder Morgan, Altair Group, People's United Financial, Chevron, AT&T, Philip Morris, and Seagate Technology Holdings. Now let's take a look what we have from our metrics for SCHG. Their assets under management is around $3 billion. They have a total of 52 stocks in their portfolio. Their MAR actually on the higher end if you compare it to the other three ETFs. This one has it at 0.3%. So it's the highest MAR among all these four ETFs we talked about today. And their current dividend yield though is also on the higher end, which is pretty good. They have it at 4% as of today, which gives us an effective dividend yield of 3.7%, which is still pretty good, and it's on the higher end if you compare to the first two ETFs. So overall, every month we're going to be getting more dividends back, but again, it's not necessarily means that the over long-term period the return is going to be more. This ETF pay out dividends on a monthly basis, so you would be getting dividends paid every single month. That's what I like, and that's one of the reasons I have this one in my portfolio. Now looking at the compound returns since the inception of this ETF, which was also at 2006, so it's been some time for this ETF on the market, and they went through pretty big market crashes in their lifetime, and the return they have actually pretty good as well, is 11%. So since 2006, they return annually around 11%. That compares pretty nicely to S&P 500 index, which returns around 10.5% for the same time period. Their drip amount is actually on the higher end, and that would be because these dividends are paid monthly, so your drip would start working on a monthly basis as well. And the amount is that $17,100. So you can invest this amount into this ETF, and then you would be getting enough dividends every single month that you would be able to reinvest back into this ETF automatically to gain from the compound growth. And that covers the best, in my opinion, dividend ETFs on the US stock market today. Let me know in comments if you think otherwise, or if you have any of this in your portfolio. Don't forget to smash that like button, subscribe to my channel. hit the bell, and I'll see you around. Stay safe out there. Cheers, bye.